Good morning. Welcome to this fastTrack webinar, where we're going to cover insurance purpose, principles and practice. My name is Julia Graham. I'm the Deputy CEO and Technical Director at AIRMIC, and it's my pleasure to invite you to this first session in the new fastTrack programme. The fastTrack programme, as many of you may know, travels over 2 years and will involve 30 sessions like today, plus 2 forums or small conferences, the first of which in the new programme is going to be on the 9th of July this year. Sorry, 8th of July this year. Don't turn up on the wrong day. So this is a first session, and therefore I'm absolutely delighted to welcome Tom Hoad, who's going to take us through this session today. It is going to be delivered virtually, and we will deliver these sessions virtually up until July, when we'll make a decision as to whether or not we carry on a virtual basis or we revert back, as we've done in the past, to running these sessions face-to-face. If you want to know what sessions are coming up, always please go to the webinar where you'll find on our website the latest sessions and the most up-to-date descriptions and dates, because they do change, and therefore to keep up to date, that's where you'll find the information that you need to have. So if I move on, learning objectives for today. So after today, you should be able to explain the basic insurance principles, insurers, brokers, and the market, appreciate basic insurer pricing and portfolio management, appreciate how to commercially apply insurance to risk management, and that connection increasingly important these days, and to identify what risks are likely to rise in importance over the next decade and how to think creatively about responding to them. So a little look into the future. In terms of asking questions, this is how you can ask a question. Use the question panel in the GoToWebinar console. And as it says on the screen, if that's not visible, just click the orange arrow to expand it. Now, a little bit more about our speaker today. Tom Hoad is Head of Innovation at Tokio Marine Kiln and co-chair of the Lloyd's Product Innovation Facility, sometimes euphemistically known as the PIF. Tom is responsible for leading Tokio Marine Kiln's product development strategy, including R&D, product development, risk incubation, and Tom, I hope you're going to explain exactly what risk incubation means later on, and scale. He's been responsible for developing and underwriting dozens of new insurances over his career, mainly relating to intangible risk, supply chain, and non-damage business interruption. Tom's got a first-class MSc in Insurance and Risk Management from Cass Business School, so incredibly well qualified, but also a fun presenter and a great friend of AIRMIC. Tom, I'm absolutely thrilled that you're with us here today, and I'm now going to hand over to you, and the platform is yours. Thank you for being with us.
Thank you, Julia. I'm assuming that you can all hear me, and thanks very much for having me. It feels extremely weird talking to myself on this screen and trying to explain all of this wonderful stuff that you're about to hear. I can see a picture of a goat has already appeared. That's great. And no doubt behind me, you can see that I'm sitting in my front room with my wife's decor surrounding me. So if you want to know, there's a statue of elephants over there and a bookcase over there. I think I flouted just about every piece of advice as to how you're supposed to do these webinars. So there we are, some interesting background for you to look at whilst I bore you with insurance discussion. But nevertheless, one of the things I wanted to check first, please, if we can, is I wanted to see whether or not we're all comfortable with asking questions. So can a few of you just ask me a random question in the question box, please? Now I'm pointing over there. You can't see what I'm pointing at, but it's basically this dashboard thing on the right that says questions. And at the moment, I don't think I've got any questions, and I've not got any new. Ah, look at that, Sophie Butler. You're my favourite already. Thank you very much. What is your? I'm gonna have a look at this. What is your favourite book on the bookshelf? Should we go and have a look? We might as well start with that. Yes, it's probably quite a good one. I've got this, which is the Brain Bending Basics. It's one of the kids' books. As you can imagine, very highbrow, in the Hoad family. Anyway, so what's with the spoons? This is great. So I will now come back to those questions now, knowing that you are all quite entertaining and that we can ask questions throughout, which is really great. So keep asking questions as they come in. Julia will probably help vet the questions so that we now become a lot more mature and go through insurance discussions. Right, so good. Okay, so in my world, sometimes it's important to think about what the need is for insurance. Now, very lucky I work for Tokio Marine Kiln, and I'm also very lucky in that I've been out to Japan and I've been to a place called Sendai, which is where the Tohoku earthquake happened and the tsunami hit the landfall. So I've seen firsthand what it looks like after the tsunamis come through and all of the damage and disruption it caused. And from a Japanese standpoint, the Japanese really have this kind of culture where they live with risk. They live with the real life consequences of disasters. So from my standpoint, it's a very evocative subject. And I really do believe that insurance has a societal need. So I'd like to start with that concept and just talk you through how I sort of see this beginning. So in the pictures you've got on the left-hand side, can you go back? Thank you, Matt. So on the left-hand side, we've got a village from Anglo-Saxon times, if you like. And then we've got a picture of a goat and a fire. The goat could obviously die, and one of the families in the village may not have any milk or may not have any meat or whatever it is, the main source of income for them, or a house could burn down. And you know, these things would happen all the time. And if you think about it, if you're in the village and you're looking to you know, look after the village, if you're a village elder or you're participating in the safeguarding of the village, then you can kind of imagine this discussion. You could say, you know, oh, John's lost his goat, the family don't have anything to do, they might be a bit worried about John, he might go on a thieving rampage around the village stealing everyone else's goat, or he might need his house rebuilt, or whatever it is. But you can imagine how in the kind of inner sanctum of the village, there's discussion about what's happened, how bad was it, what can we do about it as a village, and what happens if we don't do anything about it. And then also, interestingly, from a risk management standpoint, what can we do to prevent this from happening again? So from a societal standpoint, insurance is born out of this community need, this societal need for sharing in the fortunes of the community. So I just wanted to start with that, and that's kind of how I want to frame the rest of the discussion here, is really thinking about insurance in that way, and we can use that as the foundation for moving forward. Okay, next slide, please. Thank you very much. So from that village feel, we've got, you know, the evolution of what then happened from that point. So as you can imagine, villages turned into cities, cities turned into countries, countries turned into the world eventually, and the increasing interconnected nature of the world gave rise to all sorts of different financial services. And I think insurance really was born out of the fact that, you know, scale in insurance and really empirical data that supports risk probabilities are really kind of the fundamental tenets to why insurance exists today. Because rather than having a village coping with its own micro disasters, insurance is really there to cater for disasters for lots of different types of communities in a centralized way and trying to run itself in a really efficient way. So really that's kind of how insurance has really come about. And I'm not going to give you a history lesson on this. I'm not the best person to do it, but there are some wonderful stories that you can read about from Lloyd's, or you can read about from some of the other insurance companies. Could you go back one slide, please? I promise to speed up in a minute. So I think that's really a good way of thinking about how insurance has emerged. So some of the things the village would have been debating, like should we pay John back for his lost goat? What kind of things do we want the village to be doing to protect themselves from fire? How do we make sure that going forward, that if we pay a claim, that there's an ability to kind of recoup what we've paid out as a village, you know, to look after John? What do we get back from it? All of that sort of thinking underpins really what insurance is. And having built that system, it then has also fragmented into different roles within risk. So on the right hand side, I like to call this the Julia Graham stool, because it's really Julia's thinking this rather than mine, but I've heard her refer to this tripartite relationship between brokers, insurers, and risk managers, all three working together to get the right solution. And I think that's a really nice way of thinking about it. There are different aspects to risk, the company view, what the market can offer, and what individual insurers can offer. And I think those three things do come together nicely. And of course, there are loss adjusters and other things as well. But largely speaking, that's how the industry has evolved. So next slide, please. Thank you very much. And of course, you know, in 2019, and this is an old photo, this is a picture of inside Lloyd's of London, where I work. And this is not the whole insurance market, of course. This is just this sort of specialist end of the insurance market. But you can see the kind of risk community at its best here, working together to try and find the right insurance carrier for the right risk, the right price, the right terms, the right conditions. It really is this sort of face-to-face sort of trading environment that we had in 2019. And you know, looking forward, 2021 on, I think that the elements of this will probably still exist, but there are so many now digital forms of trading that we'll have to think cleverly about how best to supplement what face-to-face we need and what non-face-to-face we need. So still a really important part of the market, Lloyd's, and important to kind of understand. So there we are. Next slide, please. Thank you very much. So if you click on again, so I just thought I'd take you back to my first day. So I remember coming out of Bank Station and being greeted by this statue of Wellington and the Royal Exchange that's behind the statue of Wellington. And to be perfectly honest with you, I was in absolute awe. I mean, I'd been up for an interview before, but for some reason, I hadn't really noticed anything. I think I was too excited about the interview. But I was overwhelmed by what the City of London was like. It was so austere and, to be honest, terrifying. I remember I was on the phone to my friend saying, I've got a job, they're going to pay me money, which was quite a big deal for me at the time. But at the same time, in 2005, Hurricane Katrina had come through. So the market was in turmoil. And I remember seeing Lloyd's and thinking, what a strange looking building. I mean, it's just, you know, it's a big steel clad thing. And then below the picture of me is a broker's slipcase. And I just thought, as an interesting anecdote, the slipcase there is really what people used to carry around Lloyd's, vast reams of paper. And these things could get, you know, hugely big, with just file after file after file. And it just sort of amazed me that people were just carrying around huge contracts in these slipcases everywhere. And that's done much less so today, but it's still important. And then just anecdotally, the bottom right, I do also remember that in my first day, aside from this austere front, I was taken to the downstairs of something called the Elephant, which is, this is a picture of it. And I remember feeling actually horrified about what was going on in there. I think I was referred to as the Nipper, and I was bought a pint. So I then thought, well, that's not necessarily how I want my career to go. Anyway, so if you move on from that slide, some of the things that came up in the first couple of weeks, I'm sure I haven't captured all of them, but again, you know, there were some weird words these people were using. Indemnity. Indemnity really means just putting someone back in the position they were it not for the loss. So if you had 10,000 and you had a loss, then insurance is supposed to give you back the difference between 10,000 and what you had left. So if you had left 2, you might pay 8. What insurance doesn't do is to pay you more than you lost, because that invokes a concept called betterment, which might change the behavior of certain insureds. And the exceptions to that are things like new for old and other bits and pieces in personal lines, some agreed value contracts. I'll pick a couple of these, but if you want to use the questions box, which I'm pointing to, which you don't know where I'm pointing, is there anything in particular you want to understand on this slide? I'm happy to take any particular reference, or if you're not going to do that, I'll pick another one just now. Subrogation, which basically is a word that basically means that when you've paid a loss as an insurer, you are put into a situation where you sort of step into the shoes of the insured, and you have all things available to the insured that, oh yes, good, thanks Laura. Rate online, and okay, good, I've got those. Okay, I need to make this box a bit bigger. So On subrogation, it's basically things like you pay a loss, and then as the insurer steps into your shoes as the insured and has all rights and remedies available to you. And that means that you're made whole for your loss, but the insurer can recover from a third party. A rate on line, which Louise has asked about, rate on line is a function of pricing. So it's the percentage rate for the exposure. So it's a pricing terminology. So if you have a 1% rate, it means that you're paying a 1% premium on the limit that's being given. And that rate on line terminology is used a lot in Lloyd's as well. CAT means catastrophe. It's used all the time in insurance. Insurers are absolutely obsessed with this calculation that Lloyd's use called LCM5, Lloyd's Capital Model 5, and CAT losses are things like hurricanes, floods, and other things that accumulate or stack risk. And you can imagine from an insurer's standpoint, if you go back to the village analogy, a CAT risk is really something where you would be concerned that the whole village could be affected by one thing. So flooding, for example, would be a CAT type risk. Ag, this is good. I'm glad you're asking. Thanks, Darren. Ag is really how much risk you've got in the aggregate. So ag is used all the time. Whilst I've been at home, my wife has said, "What is ag?" They just keep talking about ag all the time. Ag is really how much capacity an insurer has in aggregate for a particular risk. So if you've sold a lot of insurance, you're running up against your ag limits. You can also use it in different terms which relate to how the policy might be affected or things like that. So losses in the aggregate or other things like that as well. Pen and stamp. So you can't carry on.
Tom, it was Julia here. I was just going to mention one thing. Just sorry to interrupt here, but please carry on when I've made a quick comment that EMIC are publishing a new explained guide in our Explain series on the principles of insurance. And what we'll do for those online, we'll make sure that all of the expressions that you've got on this slide are in that guide and that we provide an explanation of them, because that will be very useful for all the people who can't be with us today as well. So do watch out for that new guide. It will be coming to you soon, and we'll make sure that all that jargon is covered in the guide itself. Thanks, Tom.
Perfect, Julia. And I would reinforce that I've looked on the EMIC website in particular. There's so much content on there. I use it for some of my R&D as well. A pen is just an underwriter at Lloyd's has the pen, and they put a stamp down when they conclude a contract. And finally, flexor perils are fire, lightning, explosion and aircraft impact. So these are restricted perils that you could get property cover for. But as Julia said, I think these and other things far broader than this jargon will be given to you in a different way. So that's a good point to move on from there. So just thinking about remembering the stool and thinking about the three elements of the market, the insurers, the brokers, and really risk managers, you guys. What do insurers do? So insurers really, from the outside, they seem very sort of statistical, mathematical, actuarial-based entities that really seem to be super sophisticated and other bits and pieces. And that is true. And insurers obsess over risk pricing, ag, catastrophes, all sorts of other things. But ultimately, what insurers are actually trying to do is behave a bit like a fruit and veg seller. So the reason why I'm using this analogy is because it appeals to me, and I think it simplifies the equation. If you imagine different types of risk as being different types of fruit and vegetables, then what that really means is what insurers are trying to do is sell avocados, limes, grapes, grapefruits, and different things all the time, which might be directors and offers insurance, professional indemnity, marine cargo, and property insurance. And actually all those different types of risks or fruit and vegetables behave in a different way. Could you just go back one slide, please? And as those risks accrue into a portfolio, an insurer gets benefit from the variety of different types of fruit and vegetables. So actually, if they're selling a really nice, well-balanced book of avocados, grapes, kumquats, and kiwis, then the capital burden on that market stall, as it were, is reduced, because it's very unlikely that you would have a loss of avocados, complete loss of avocados, at the same time you have a complete loss of lemons. So that principle is really how insurers make a return on housing these risks for the community. And of course, on the right-hand side at the bottom there, the insurers then compete in marketplaces with lots of other fruit and vegetable sellers. So yes, they're technical, but they're actually doing something relatively simple, which is having a view on how they want to present fruit and vegetables in a fruit and vegetable marketplace. So simplified insurance for you in that respect. Next slide, please. And those sorts of things, as quite rightly prompted on, relate to, you know, ships, bricks, property, aviation, data, you know, reputational risk, and all sorts of other things. So one of the things in your careers you'll see, and we'll get onto this a bit later, is insurers pushing the boundaries on what's insurable, because from a portfolio standpoint, they love the idea of selling a new type of fruit and vegetable, or selling it in a different way, or a fruit salad, because actually that's a way for insurers to balance that portfolio and create a better product for risk managers, but also help insurers balance the books in a better way. So hopefully that's made sense. Next slide, please. And in terms of how they assess whether or not selling an apple or a banana is a good idea, really the equation is quite simple. It's how many apples and bananas can you get in? And then if you do get them in, what are the kind of lost case scenarios that could happen as a result of having them? So in insurance terms, the bottom line of what looks like some weird sort of heart rate monitor at the bottom is really just premiums coming into an insurer over a whole account. And then the lines that stick out from that are the losses that the insurer is paying out. Now, this happens to be quite a nice account in that the actual loss ratio on this, I think, is 67%, which means that for every £1 of premium an insurer takes in, it's only paying out 33 pence. It's only paying out 67 pence in claims, keeping 33 pence as profit. Now, from a fruit and veg standpoint, that is a healthy banana or a healthy apple. So that is contributing to that portfolio variance calculation that we talked about before. So that's a great account. And if you could go to the next slide, please. And then in terms of a bad account, and again, forgive me for how bad this looks, but as this is effectively trying to show you that in the same sort of guise, this might be cherries. The premium for cherries has come in on the bottom line, the dark blue lines, and then the gray lines are really kind of the loss experience of it. So this particular insurer has sold cherries at too low a price, and actually from a market standpoint, this is now a real problem because the insurer's paying out, I think it's 400% of what it took in claims. Now, in terms of a portfolio, that means that this account is actually losing the insurer money, and the insurer then hopes that the other fruit and vegetables are doing better so that they'll offset the losses from this particular account. So in risk terms, this is the equivalent of an aviation account or another account that's gone badly wrong for the year, and insurers making healthy claims to clients. Next slide, please. And on top of this, and we're getting into the realms of something a bit too technical here, but insurers also, when they're looking at these types of accounts, don't just say, well, we'll sell cherries. What they like to also do is to think about how, if you're selling cherries, do you want to be paying claims as soon as something happens, or if something happens of a certain magnitude? Now, in that scenario, insurers also pick and choose where in the spectrum of potential severity, the size of the loss, they might want to participate. And there are all sorts of different tools for pricing risk at different layers of any insurance program. So it might seem on the face of it that a broker's in the market looking for a price for D&O, directors and officers insurance. In reality, what they're actually doing is trying to fill your requirement, which is a 50 million limit, with multiple insurers, because different insurers might be better at the 10 million over 40 million loss layer than they might be at the 0 to 10 million layer. And there'll be pricing nuance all the way up those charts. And what these curves show you is they're not exhaustive at all. There are lots of different ways of doing this, but largely, when you won't be able to sit on this graph, I can just see that now. But it's basically saying the portion of the severity of the loss is attributed to the real front end of it, and then the pricing tails off or slows down as you go higher up. So this is it's a complicated subject, but just be aware of the fact that at different layers or different levels of severity, insurers also come up with different pricing models. So when you're in the market thinking about the overall cost to you to buy insurance, think about how the broker has gone round and manipulated the market to get you the best overall price from what options are out there. Next slide, please. And again, if you think about that in practice, if you think this example is a unfortunate fire in a building, the different pricing on the bottom side here underneath the picture is really trying to say, what does the primary 10 million? So the primary means the first layer, the primary 10 million. What's the price for the 10 million, excess of 10 million, and so on and so forth. And then when the claim actually happens, what happens is you collect from each of those insurers as it goes up and up and up to the full value. And in this case, I mean, it's difficult to really kind of give you a feel on this because I actually don't know which building this is, unfortunately. But if the sum insured was 50 million, it may well be that the total loss here was only 30 million, in which case those insurers that gave you the risk transfer above 30 million actually don't pay anything in this circumstance, unless there's some argument over contribution and other bits and pieces. And so just have a think about that. Have a think about the dynamic between how much risk you retain and how much risk you transfer, and then how risk is transferred in the market. Perfect. So moving on to brokers. So again, in this slide, it's really sort of saying, well, okay, so how do we navigate this market? Now, I used to be a terrible broker. I knew the market, but for whatever reason, I wasn't brilliant at it. I did more consultancy to banks and things like that. But brokers, they know the market, so they know how these insurers are thinking. They know that an insurer is thinking about, well, I know that, you know, Sandra from this insurance company over there, she really likes writing deals that are like right in the tail end of that severity. So she'll only come involved if she's pricing risk at 10 million over 40 million. And I know that she's got a great price at that layer. And also that broker who's going in to see her might also know that they've got a big book of business with her. So they may also know that there's some leverage there in terms of how they can be persuasive. Brokers also interpret what's going on. So you'll have all sorts of risk needs in your companies that may seem completely like beyond the scope of any insurance remit, but actually brokers do a fantastic job of listening. Well, they should do a fantastic job of listening to your needs, trying to understand what you're trying to achieve, the strategy of the business and so on and so forth, and interpreting that. And then they can advise you on how the market's behaving and give you excellent tactics for approaching the market so as to give you the right answers that you're looking for. So if you can go to the next slide, please.
So Tom, while you're just talking about that, can I just jump in here with a question that's come through? Because we've got a lot of perhaps members who have not been in the profession for an enormous length of time, who've never lived through some of the cycles that we're seeing at the moment, almost boom and bust on insurance premiums. So is the particular tough market that we're enduring now that many people haven't lived through before, is that where particularly the broker comes into their own?
Yeah, and if you turn to the next slide, actually, I've pinched this next slide from Hollard, who's a South African insurer, but this will give you a quick trot through what that hard and soft market actually looks like. So in a soft market, you can see that competition for your risk premium becomes very fierce, and the price of your risk transfer reduces. Then disasters tend to happen, and you can have various forms of disasters. Those cats that we talked about, but you can have other types of disasters like pandemics and other bits and pieces, which then means that insurers suddenly think, oh no, we're paying out far too much here, which means insurers exit the market at that point. And then the price goes up again. And then at that point, the insurers think, oh no, maybe we should go back into the market, or new insurers start coming into the market. And of course, then the insurers start making money out of it, and then another loss comes, and so on and so forth. And there are different ways that hard and soft market kind of behaves. But ultimately, what's actually going on is that various different dynamics across the macro market and in specific industry sectors and in specific insurances all play out in practice. And what you're trying to do is to make sure that you've got your best eyes and ears out there to navigate those price increases along with your budgeting cycle, along with how you report back internally about risk transfer, and along with all sorts of things. To be honest, it's tricky. But at the moment, I think the market is in a kind of like a hard period where insurers really haven't made the returns they're expected to make. The previous period was quite a long, protracted soft period where pricing adequacy was below where it needed to be. And that's meant insurers should have technically come out, but there's actually been so much supply of new insurance capital to the market that's been protracted for longer. We've obviously got losses from the pandemic, and we've got major event cancellation losses everywhere. And that is driving prices up in certain areas and quite significantly in some areas. And in other areas, it's a bit flatter. So the cycle in macro terms does go soft, hard like that. But actually, there are classes that behave differently inside it. So it's a difference between the whole fruit and veg stand being affected and all being priced up or all being priced down, and then individual fruit and veg also behaving slightly differently in it. Australian D&O is a good example where quite cheap, loads of losses, price goes straight through the roof. So hopefully that's helpful. Thanks for the question though, Julia. Okay, so moving on. So this is a section I just wanted to sort of spend a bit more time on. And the first thing to say is, risk management, it's a tricky business getting all of that right. And I absolutely am not intending, especially with Julia Graham on the phone, going through ISO 31000. But there is an enormous amount of resource on the AIRMIC website and through all the programs that are available to you, either virtually or through some of these guides that I put an example. There's a great one I found that Marsh helped out with as well, which is sort of explaining all sorts of different types of risk. Julia, did you want to?
Yeah, that's a great segue into an advert, Tom. First of all, I'll just jump in there that when you were talking about the hard market, we've actually got a webinar dedicated to that subject tomorrow. So those are online. Do go and look at the AIRMIC website because you'll find details of that AIRMIC live session. But the other thing I want to mention is that we've got the second in the Academy series of webinars on the 9th of February, when we're going to cover this very specific issue. Because we feel these two subjects walk hand in glove these days. You can't really manage insurance if you don't understand about how to manage risk. So we're going to run a separate webinar. So thanks for the introduction into that subject, Tom. Great point.
No, that's great. And sneakily, that's got me out of explaining that whole diagram on the left. So that's also excellent. One of the things that I think is also important is that from what I've seen, and the risk managers that I've had the pleasure of dealing with over the years, is I've seen a shift in risk management from being, making sure there's a corporate resilience to core risks, to considering how risk management can be used far more strategically in the way that a corporate conducts its business. And there've been some really, really great discussions that I've been lucky enough to have over the years that have related to some completely new topics. But I thought what I'd do is just slow down a bit now, having had the trot, and go into a bit more of a walk through some issues to do with contractual liability. Thank you, that's perfect. So just to put this into context, what I mean here is that bearing in mind that what we've just talked about is the transfer of risk. The transfer of risk can also help enable your businesses to be more effective in the way that they trade. And this area is not new to risk management, but it's really becoming, I think, more important as the world evolves and as competition for business really has increased, especially on a global stage. So in this context, imagine that your board is actually looking to sell part of your company, and they want to get 20 million quid for it. You've been brought in to sort of look at this transaction and help explore the options that you might have to look at the transfer of risk in relation to this divestiture. It's a pretty simple equation. What actually happens is, in practice, that when you get your buyer, under English law, we have this term caveat emptor, buyer beware. And that really means that the recoveries that are available to you as the buyer are not really founded or enshrined in English law in any particularly specific way. You pay the 20 million and then you just take whatever state and guise it in. So the clever lawyers make large contracts around this. So they have things called sale and purchase agreements or derivations of agreements that are called things like that. And that establishes liability under contract rather than relying on de facto English law. And that means that in a contract, what you would be doing in this instance is selling your business, taking 20 million for it, and then giving the buyer a contract that says, when you've bought this, we will also pay you up to £2 million in the event that any of these statements are untrue, that there's not been enough tax paid, that we own the property, that we can sign the agreement, and that we've disclosed the right things. And there are lots of variations of this, but I've tried to keep this really simple. So the situation, just to go through it again, you sell for 20, you also give a contract. After the buyer has bought your company that you're divesting, then they can also come back to you under contract for, say, 2 to 5 years in respect of these issues. So if, for example, on day 50, it turns out that we as the seller didn't have the right authority to sign the agreement, then the buyer can say, well, hold on a second, this has caused us a major issue. We want 1.5 million quid or whatever it's cost us. So just think about that as a context. Now, if you could move to the next slide, please. So what you can do, and what is done regularly, is you can obviously work with your internal teams to make sure that all of these things that we're saying in contract are actually true and accurate. And that's great. It's a great starting point. And that would probably mean working in particular with the legal team, who probably would have got an external legal counsel involved in advising. But you can also do something where you might obtain a quote for a specific type of insurance. And this particular insurance happens to be called warranty and indemnity insurance. And let's just go through what might happen if you were successful in this particular approach of risk transfer. So you go to market with your broker, and the broker returns an option to insure with, let's say, 2 insurers, a 5 million limit, but that will cost you £80,000, and you will have to bear £1 million of that risk as a deductible. So remember, the broker may have struggled to get a lower deductible than 1 million in the market, and there'll probably be options for the pricing, and there might be some other conditions, so on and so forth. But we're basically presenting the board back with this quote. And that means if we do the normal deal, then what we would do is forget the insurance. We would take the balance sheet liability. So that's the liability on our account that would accrue to us after we sold the company for 20 million quid. We have to hold that probably 2 million back just to make sure that we've got enough cash to pay for things that go wrong. But we get the 20 million. So we get 20 million up front. Great. Everyone's happy, and we keep the 2 million. And if something goes wrong, we need to pay it, and that's what we make good on. And we may be confident about that. We may be not so confident or whatever. But let's look at what happens then if you use the quote that we obtained from the market. So in this instance, what's actually happening is we're insuring the risk that these contractual terms are called on. And the way we're doing it is we're using a form of insurance called warranty and indemnity. So in this instance, we're paying 80 grand to an insurer. But because the limit that the insurer is giving us is now 5 million, we're also offering the 5 million limit as a contractual term that bumps up the recovery that the buyer could get from us after we've sold this company to them. So rather than them coming back to us for 2 million, we're now saying that it's worth 5 million. So that has actually pushed the sale price up to 21 million. And also because of the way this insurance is structured, we're now only taking really 1 million in balance sheet liability going forward. So do you see what we've done there? We've sort of engineered risk so as to get a better commercial outcome out of a transaction. And I think what this does is it can help reduce this balance sheet liability. It could increase the sale price in some circumstances, I think more importantly for me than anything else, I think this champions what I see the risk management community really evolving quite quickly into, which is a much more strategically aligned enablement function that really helps businesses navigate the world of risk by being clever about what risk transfer helps other financial equations. So hopefully you've understood that, and I'm happy to take any questions that there are on that, but I've also got another example to go through. So unless there's anyone burning to ask a question, I'll just go through the second example and then hopefully that reinforces it. So in this second example, we've got a company who make haptic headbands. I don't know why I came up with this, it just sounded really cool. And I think that's from Claire's Accessories, so apologies. But basically we're saying that they light up when you hear some music, and people love these, right? So we want to get into a major supermarket chain, and they're saying, yeah, okay, we'll take 100,000 units off you. We're really excited about this as a business, and that will give us £1 million profit for year one to the company. But we're also aware that there's a few other products out there in the market. And again, with the risk functions being asked to sort of get involved with this transaction to really help realize the deal for our growing company. One of the things that we notice is in working with the legal teams that there are some contractual undertakings that we need to comply with in order to sort of complete and deliver this particular supply to the supermarket chain, including there's a clause in there that makes us have to sort of, keep them safe from any issues where they may be embroiled in some form of challenge made against them and the headbands that says, actually, hold on a second, those headbands are actually infringing on our intellectual property. We want you to stop doing that and pay us some royalties for it. In those circumstances, you could imagine from the supermarket standpoint, they don't really want to get involved in these things. And, given the plethora of different products they're selling at any one time, having the supermarket's legal team embroiled in all this stuff is really unhelpful, actually. So these contractual liabilities are designed to protect the supermarket from you or us, in this case, getting our headbands into a large supermarket store without taking on the responsibility of protecting them from these outcomes. So if we could just go to the next slide, please. So in this instance, what can you do? What do you do? Obviously, check the contracts, work with the legal teams, talk with different areas of the business and think about sales and so on and so forth. And then possibly consider obtaining some quotes for intellectual property insurance. So remember that in this instance, what you can do is you go to the market. Again, simple terms, we're thinking about a 5 million limit. This product's going to cost you 100 grand and you have to bear a 500 grand deductible. And the insurer gives this clever potential consequential loss extension for 1 million, and that will cost you an extra 50 grand. Just to be clear, a consequential loss means, in this instance, the indirect impact on the supermarket chain for them having to remediate beyond just what your relationship is with them. So what that might mean is that they may lose money from sales that they would have had ongoing were it not for the loss, and other different bits and pieces. And let's just assume that from a simple contractual standpoint, that's quite clearly understood. And in this case, the supermarket said that, if we have to pull these products because of an intellectual property challenge, it's going to cost us £1 million. So it's agreed in contract, just for simplicity's sake. So if you were to go through the normal deal, then effectively you take on this balance sheet liability or this contingent liability of £5 million, but you make 1 million profit. Now, if all goes well, brilliant, you've made £1 million profit and you don't incur any liabilities. But in the risk-enabled deal, what you can do is you can actually say, well, we'll reduce our contingent liability down to £500,000. We'll still make the £1 million sales, and we'll pay out an insurance cost of 100 grand to 150 grand, depending on which deal we went to. Now, it may look to you like, well, what's the point in that, Tom? Well, it may well be that in this circumstance, the competition to win the deal is so fierce that as the risk team, we need to come up with something clever to put us ahead of the pack. Now, in this particular instance, what we're doing is we're offering the large supermarket a higher limit. So we're actually offering them the coverage for it. We're reducing our amount, and then we're offering the higher limit of the consequential loss. So it's a kind of an extra piece that an extra sweetener to the deal that says, you know what, if you have to pull our product, we'll also make sure we keep you whole for your consequential losses that will not normally be covered under contract. Now, that might be enough to compete better against an alternative. Now, obviously, that's quite complicated, but what I'm trying to get at is that there are some really ingenious ways of using insurance to look at the way that deals, commercial deals, go through. And the allocation of risk in terms of commercial deals is an area that I've seen really grow in the risk management community, to the point where we start building products around that commercial enablement. Because from our perspective as insurers, we should be best placed to cover off these liabilities, because we should have the financial wherewithal to be able to do that in a more efficient way than you might be able to do on your own. And therefore, it's a kind of a win-win situation for everyone involved. We get premium income where we otherwise might not. You get a better deal, and everyone feels very happy about the whole thing. So I know that's quite complicated, and in a normal circumstance, we'd have more time to discuss this sort of thing. So I'm happy to take questions on this. But I just thought that was worth slowing down and going through before we move on to the final slide. Okay.
I've got a question, Tom, and that is about the subject of loan corridors relative to deductibles. Is that something you can comment on?
I'm not sure entirely what you mean by a loan corridor, Ray.
So I'm not quite sure what that means either, and I thought you were going to jump in and go, yeah, this is what it means. So whoever asked that question, just pop a little bit more detail into your question, and we'll make sure it's addressed before we finish the session.
Yeah, perfect.
I've got a couple of others, Tom, but they will keep till the end. So
well, I've got a few minutes just to go, and then we've got plenty of time for questions, if that's all right. Perfect. Next slide, please. So we're going to leave you with this thing to watch on YouTube, because it's difficult to do that virtually. It'll take 2 minutes out of our Q&A. But one thing to consider is the companies you just joined or have joined or are in for some time are evolving and will evolve considerably. And the dependency that your companies have on things that used to be strategically important to the company from 10 or 20 years ago are going to be completely different in 10 or 20 years time. I mean, coronavirus is just an unfortunate but brilliant example of the rapid digitization of things. I mean, all sorts of things are happening now that we would never even conceived of 18 months ago. And just to give you an example of this, to illustrate it, the video on YouTube really shows you, it's like a time lapse of how the market cap of the largest companies, I think in the US, has changed over 20 years. And what you see in the text below the link there is that energy, telco, finance, consumer stuff has basically been replaced by tech. And it seems obvious, right? But actually, that evolution of our business is never really happened in a way like it is happening at the moment. So as your careers evolve and develop, like mine has, we've all got to be super clear about the way by which risk is changing in commercial context for all of us. And we have to be able to react and respond to that in an effective way. And if you could go to the next slide, please. One of the things that's really important about that is to find the right way of considering some of these issues and how to interact with other people who have similar concerns and needs. So, for example, in 2020, during lockdown, what Julia and I and others did was to set up something called Future Minds, where we used Lloyd's virtual infrastructure and their virtual lab environment to invite over 100 individuals into Lloyd's to talk about intellectual property risks. And this was at a time where it was so obvious that the reliance on intellectual property was going to far outweigh, normal physical property. So things like, patents, trademarks, reputation, brand, the digital economy. I mean, so many different elements of it had to come together. And through this process, what we did was we put some consultancy around it to help frame the subject matter, more consultancy around it to help frame what we determined to be sort of ideas sprints. And really it helped everyone network and come together and think about things. And just from my perspective, what we had 8 people from Tokio Marine Kiln attend this. And they were talking to risk managers, they were talking to brokers, but they were talking to subject matter experts as well about how reputation risk has evolved. What do we need to do to understand it? How do we kind of create the right products for it? How do we stop selling the wrong products for it and getting worried about why no one buys them? You know, these are things that insurers think about quite a lot. And if you think about it again, from where we've come through on this discussion, at the start, we're thinking about how fruit and vegetable markets need to expand in order to maintain relevance and that variability in the way that risk behaves in it. These areas really should be at the forefront of an insurer's mind. And Lloyd's also announced in 2020 that 2% of all Lloyd's income is now going to be available for innovation products. And just to put that in context, that creates a marketplace in 2021 of roughly £660 million of potential premium income to write innovation products. I think that's an absolutely fantastic decision by Lloyd's. And if you think about that over a 10-year period, if the market did actually write £660 million of premium income, that's a nearly £7 billion marketplace without any growth in it. So this is a major move by insurers to really consider how do we evolve rapidly to cater for these risks that are not just on the horizon, but they're actually there in front of us. So this is really kind of like a call to action in that there are new versions of Future Minds coming out this year. I think there's one on human capital that starts in a week or so, and there'll be others later in the year. But this is really our invite from the insurance community to you guys to say, come and have a chat with us and discuss how we can best solve together these things on the horizon and how to get them right so they're useful for you, really. So I think that's the end of all the things I wanted to chat about. And in the interest of having some Q&A, I just thought we can find out what a loan corridor is and take any other questions.
Well, I'm working on it to find out what the loan corridor is. And I think the first sort of lesson on that, Tom, is however far you are on in your career, you never wing it when you don't know what the answer is. I think, it's quite a difficult thing to be brave, to step up and say, I don't understand what that means, because you'll find that the people around you probably don't know either. So never be afraid to challenge however long you are into the career. I love the comment that you made about strategically aligned enabler. And I would say to the people online today, what would you like to be? Do you want to be a buyer, or do you want to be a strategically aligned enabler? And I know what I would rather be in a business, the person who enables rather than the person who says you can't do something. So I think it's an ambition we should all strive to. And I love the expression that you use. And you know, this fast-track program is part of the EMIC professional journey to help people realise that type of ambition. So I really appreciate the session today. Now, I've got a couple of other questions other than one about corridors. One going back a little bit about directors and officers liability insurance, which has had a lot of attention, especially in the last 12 months. And the question is, it's been quite hard or getting harder to buy this cover, particularly in financial services organisations. I actually think it's probably harder to buy in any organisation at the moment. And the question is that a function of the hard market, or is it a function of claims? Now, that's not a trick question, but I know you're going to say there's probably a bit of connection with the two options. Do you want to comment on that?
Yeah, happy to. So D&O and PI, I'm afraid, are not my core areas of expertise, but I'm aware of what's largely going on in the marketplace. I mean, you're absolutely right. That's a function of both. There is a sort of a squeeze on return generally, and then there are some specific and quite territorially focused, as I understand, geographic areas where actually those claims have really manifested in certain ways. And with some of those classes, what you end up with are claim scenarios that could affect multiple different types of companies as well. So if you want, what I can do is take that question and get you a proper answer to that from some of our D&O experts if you want to put a bit more granularity around it.
Yeah, I think it's a fair answer at this stage in our journey, that one is a function of the other. I think the challenge with D&O is that it's an expectation that claims are on the horizon and heading our way. And what's happening in the States and even in Australia in terms of liability is always a very good indicator of what may be hitting our shores on this. So I think that's a fair answer. On going back to the loan corridor, I'm going to read this out because I've never come across this expression before. So I'm going to reveal my ignorance on this. But the person who asked the question said, in my last company, they renewed insurance and the deductible was raised from a low X value to a higher Y value. And the insurer added into the renewal a loan corridor on what is called on the web a corridor deductible. So does that help, or are you still like me thinking I'm not quite sure I've heard of that?
No, I've never heard of it. Please forgive me. I've just never heard of it.
No, I've never heard of it either. But what we'll do is we'll go away and do a bit
find out.
About it.
Yeah.
And when we post the slides from today, we'll put a couple of comments in as to what we've discovered. So we'll do a bit of research. I've also got a question on Future Minds. We have AIRMIC members involved in the Future Minds project. Is there still an opportunity going forward for AIRMIC members to get involved in this?
Oh, absolutely. I mean, there's not much point in the market developing things that don't include, people who ultimately are responsible for buying them. And more importantly than that, I think, the insurance market can be a bit too obsessive over thinking that it knows best. So actually some healthy challenge from AIRMIC members would be very welcome as to the practicalities of some of the things that are assumed. So one of the things I've noticed is that insurers will sort of launch a new, and I've been guilty of this as well, launch a new reputational risk product and assume that that's instantly understood and transferable inside a client's business. Actually, the reality is, I couldn't tell you, it's often completely the opposite. And in fact, there's no point in my experience in perpetually producing new product that ultimately, when it comes down to it, it's not communicable internally enough. So please do come, and we'll reinforce that with Lloyd's.
Yeah. So if people are interested, drop me a line and let me know, and I will pass that interest on. Now, I'm conscious of the time, that we're out of time, Tom. So I'd like to thank you so much for being with us today. A super presentation, gathering questions and giving answers along the way. Great gift. Thank you very much for being with us. I'd also like to thank the AIRMIC team behind the scenes who supported today's event, particularly to Adam Ireland, our Learning and Development Manager, who's put the new programme together. A lot of work behind the scenes, and to Matt Goldsmith, my colleague, who keeps the technology flowing. I'd also like to thank those of you who've turned up today. We've had a great audience today, and you've stayed with us, so thank you for giving us your time. We will post a recording of this webinar and the slides, so if you want to go back and refer to any of them, please do. If you're interested a little bit more in warranties and indemnities, I saw an older paper had been published on the chat today, but go and look at the M&A guide, which we published last year, because there's a whole section there at section 8 dedicated to warranties and indemnities. And do have a look at our reputation guide, which we drafted, including with some guidance from our colleagues at Lloyd's. So remember, AIRMIC Live tomorrow on the harsh market. We have a session on the World Economic Forum Global Risk Report on Thursday, and the next in the fastTrack programme series on the 9th of February is the first session on the webinars risk and managing risk. So without further ado, thank you very much for today, and take care and see you soon.